Today we're unpacking Chair Jerome Powell's October 14th of 2025 speech at NABE, where he set out to demystify the Federal Reserve's balance sheet, basically what's on it, why it matters, and how it connects to the economic outlook. He walks through kind of three big buckets, one being what the balance sheet actually is, two, how it was used and how it was used during the pandemic, and also how the Fed is normalizing it now, and then three, the current read on jobs and inflation. So think of the Fed's balance sheet as the plumbing of the financial system in a way. It's one piece of it, but anyways, that's a whole different rabbit hole for more than a 5-minute video. So on the liability side, it's mostly cash in circulation, bank reserves, and the Treasury's checking account, which is the TGA. And then on the asset side, it's Treasury and agency mortgage-backed securities that the Fed bought to stabilize markets and ease financial conditions, especially when short-term rates were at the lower bound. There's more to it, but again, one thing at a time, more or less. Powell argues that we're currently in an ample reserves regime, and that it's been working well. And the Fed is now carefully shrinking back towards a steady state without going back to the pre-pandemic system. Also on this, I made a video a while ago, and I'll put it as a card or whatever at this point in the video so that you guys can go watch it yourselves, basically detailing the specific differences between the ample and the scarce reserve regimes with graphs and so on. I believe it's also a post on my website too, so you could read it and see the charts at the same time as well, but I'll put that in there for you guys. Okay, so kind of balance sheet 101. So on October 8th, the total liabilities were about $6.5 trillion, which was roughly $2.4 trillion in currency, $3 trillion in bank reserves, and the TGA at about $800 billion. Reserves are the safest and most liquid asset in the system, and only the Fed can create them. And on the asset side, roughly $4.2 trillion in Treasuries and $2.1 in agency mortgage-backed securities. And when the Fed buys these securities, basically just credits the reserve accounts, kind of turning those securities into reserves for that bank or dealer or whatever the case is, whoever has that reserve account. Okay, second, so why this kind of matters, and looking back at like the pandemic. So in March to April of 2020, with markets seizing up, the Fed rolled out emergency facilities, peaking a bit above $200 billion in loans, and bought Treasuries and MBSs at an extraordinary pace to restore market functioning and ease financial conditions. The monthly purchase pace slowed by June of 2020, and in November to December 2021, the Fed tapered and said they would end those purchases by March of 2022. In total, security holdings rose $4.6 trillion over that period. With hindsight, Powell says the Fed could have and maybe should have stopped sooner, but stresses that expectations did much of the work. Once tapering was announced, markets priced in a faster balance sheet decline than in 2017 to 2019, which is a pretty important period. Again, that video that I talked about earlier in this one, between the ample and scarce reserve regimes is very important to that time period, and it kind of explains more in that. So the operating framework for ample reserves. So Powell underscores that policy rate control today comes from administered rates, meaning interest on reserve balances and for the overnight reverse repo facility. So not from day-to-day reserve fine-tuning as before the GFC. Since June of 2022, the balance sheet has been reduced by about $2.2 trillion, which was about 35% of GDP, down to 22% of it, with effective rate control maintained, according to him. So the committee plans to end runoff when reserves are somewhat, that's a quote, above ample, with overnight reverse repo balances now minimal. Further portfolio declines pass through more directly to reserves, which currently stand just under $3 trillion, about 10% of GDP. Tools like the standing repo facility and discount window stand ready to contain funding pressures and avoid a repeat of the September 2019 money market strains, which was when we got kind of close to that bound for the lower bound, I guess, for the ample reserves regime. Again, there's graphs and stuff in the post I was talking about earlier. So it's also worthy to ask, is paying interest on reserves costly to taxpayers? Because the Fed is sometimes thought of as an actual government entity, even though it kind of blurs the line quite a bit. Again, plenty of posts and videos and stuff on pretty much all of the channels and the website and so on, kind of going more in depth into that specifically. But anyways, so Powell says no, this isn't costly to taxpayers, partly because the Fed's interest earnings on its securities, they do actually get the interest from that, it normally exceeds the interest paid on reserves. And profits by law are remitted to the Treasury, so it goes to the TGA. Even after the recent stretch of negative net income, cumulative remittances since 2008 total over $900 billion. And net income should turn positive again, and eliminating the Fed's ability to pay interest on reserves would jeopardize rate control and could force disruptive rapid security sales. So kind of his outlook, getting away from the Fed a little bit on jobs and inflation. So Powell says the balance, it's basically a balance of risks. This has shifted because downside risks to employment have risen even as growth looks a bit firmer than expected because of the government shutdown. For example, 12-month core PCE was 2.9% in August, with core goods price increases mainly reflecting on tariffs, while housing continues to disinflate too. So the Fed took another step toward a more neutral stance in September and will remain kind of meeting by meeting, kind of just the same thing they've been saying for the past couple of years, I believe. In conclusion, Powell's message. So the balance sheet is not a black box. It's a policy tool the Fed uses alongside interest rates. The pandemic response built a larger portfolio by design, and now the Fed is normalizing it within the ample reserves framework that aims to keep markets liquid and policy effective. On the economy, the Fed sees slightly firmer growth, softer labor dynamics, and inflation that's near but not at target, with tariff effects showing up in goods prices themselves. Basically, policy is kind of inching towards neutral, but it's still data dependent. The whole data dependency and so on should kind of just be, it's repetitive, but it is what it is. Anyways, I'll leave this one here, and I hope to see you guys on the next one.